Now our focus is on Rule 11 UA1CB, unquoted equity shares. So as we discussed, Rule 11 UA1CB prescribes a formula and which is referred as the NAV, net asset value method. In this, as we have discussed already, A plus B plus C plus D minus L into PB upon PE. PB is number of shares that are to be valued, and PE is the total number of shares of that entity, and that is how you will find out the value of unquoted shares. But friends, let me tell you, when it comes to 11UA1CB, it is not as simple as the formula looks like. So because A has got different meaning, B has got different meaning, C has got different meaning, D has got different meaning, and L also has a different meaning. Let us look at and understand one by one what all these A plus B plus C means. So, the fair market value of unquoted shares shall be the value on the valuation date as determined in the following manner: A plus B plus C plus D minus L, as we have discussed. Now, what does A means here? And that is where, friends, you need to really focus and pay attention. यहाँ पर A का क्या मतलब है? A का मतलब है book value of all the assets. And remember, this is with reference to balance sheet of a company. So the rule 11 UA1CB is based on balance sheet of a company, and this formula A plus B plus C plus D minus L into PB upon PE is with regard to the balance sheet. So what does A mean in this formula? A means book value of all the assets which are given in the balance sheet other than jewelry, artistic work, shares, securities, and immovable property. So which means what? Which means in the balance sheet as reduced by. So please remember, there are two things that we need to be aware of. Number one, it is not that all the assets are to be considered as given in the balance sheet. No, all the assets are to be considered given in the balance sheet other than jewelry, artistic work, shares, securities एंड इमूवेबल प्रॉपर्टी. सो इनके अलावा जो भी आइटम्स बैलेंस शीट में है और जो भी उनकी वैल्यू है, यू कैन सिंपली पिक अप दैट वैल्यू एंड कंसीडर इट फॉर द पर्पज ऑफ वैल्यूएशन as reduced by. So this total of all the A will need to be reduced by what? Number one, any amount of income tax paid, if any, less the amount of income tax refund claimed, if any. Now this is something which is little complicated and confusing, but let me simplify it to understand. So what it says, that जो भी आपकी assets का total है, that total will need to be reduced by two items, and these are the two items. First item is amount of income tax paid. So remember, it is possible that the company whose valuation, whose unquoted shares you are trying to value, that company may have paid advance tax and TDS, and that, let's say that amount is 100 crore. Okay, so the amount of TDS paid and the amount of advance tax paid is 100 crore. Now when this company filed its return, this company has filed a return and claimed refund of 40. Why refund of 40? Because their tax liability is coming to 60. They have paid 100 crore, their tax liability is coming 60 crore, but so that means the balance is what they have claimed as a refund, and that is what is meaning here. Any amount of income tax paid, if any, less the amount of tax refund claimed, if any. So the amount of tax paid is how much? 100, and the amount of refund claim is 40. So that means difference is 60. So this figure will need to be reduced by 60. This figure will need to be reduced by 60, and that is the meaning of clause 1 under A. Number 2, it talks any amount shown as asset including amortized amount of deferred expenditure which does not represent the value of any asset. We all understand what is a deferred revenue expenditure. So deferred revenue expenditure is a lump sum expenditure that you incur in a particular year, hoping that you will get the benefit of it over next 5 6 years. What you do, you amortize the expenditure that you have incurred lump sum in 1 year. So any amount which is unamortized, please remember, is only a book figure, is only a paper figure. It doesn't have any substantial value. It is only on paper, and therefore the book value of all the assets will also need to be reduced by the amount of unamortized deferred expenditure, and that is the meaning of this clause 2 here. I hope that clarifies to everyone. In case if anyone has a doubt, you can of course please ask me, and I would be happy to take your question. Now, there are a few posers that I would like to mention. So number one is, will A in the above formula also include intangible assets? And the answer is yes. Will capital work in progress on account of tangible as well as intangible assets be considered in computation of fair market value as per Rule 11 UA 1CB? And the answer is yes. Which balance sheet should be used for the purpose of determination of valuation of unquoted equity shares? Now, this is a question which is or so much discussed. Now, will the balance sheet of the last financial year be considered, or will a new balance sheet need to be drawn every time when such transfer is going to happen? Now, in my understanding, friends, what we need to be aware of is, what is the purpose of the whole exercise? The purpose of the whole exercise is not to trouble the assessee and the company whose shares are supposed to be transferred. The purpose of the income tax department is also to ensure that the assessee and the company should not indulge into something that is going to result into loss of revenue to the department. And therefore, in my view, it is not that every time somebody decides to transfer their unquoted shares, will have to ask the company to draw the balance sheet every time. Now, please remember, that is not practically feasible, possible, because assuming that there are 10 transactions happening, then every time when the transaction is happening, will the company be asked to draw an audited balance sheet? You may ask the company, but will it be really possible for the company to do it? Because every time when you ask the company to do the audit, it means a lot of expense, a lot of money. And please remember, virtually and practically, a balance sheet is considered to be fully audited only when it is adopted and approved in the shareholders meeting. So will you also call the shareholders meeting every time whenever such valuation is to be done? Is it really workable? Is it really feasible? In my view, the answer is no. And therefore, in my view, and which I am sure is based on the fundamentals, mentals, and the practicalities. So whenever you have to do the evaluation of unquoted shares, you can take the balance sheet of the last last financial year, and make sure that all the major changes that have taken place from the time of the last balance sheet till the date of the value transfer that you are doing, all the major transactions are duly adjusted in the audited figure of the last financial year, and considering all the developments, you arrive at the fair value. Remember, what is going to happen? So you will do the transfer today, and the matter will come up for the assessment or review by the income tax department much in future. And obviously the department will ask you, all right, you did the transfer on 15th of June, or 10th, you did transfer on 10th of June using the balance sheet of 31st March 24 after making certain adjustment. Now we are in the year 26. So please show me the audited balance sheet of this company of 31st March 25. So the income tax officer can pick up the audited balance sheet of 31st March 25, and he can come to a reasonable conclusion as to, in your computation of the fair value on 10th June 24, were your numbers based on a real number, or you have tried to manipulate the number. That would become very obvious when somebody would look at the balance sheet of this company of 31st March 25. If that is what the income tax officer comes to a conclusion, obviously he is not going to accept your valuation, and he is going to question, and whatever is applicable under the income tax, he will penalty or whatever he will do. But after taking into account the audited number of 31st March 25, if he comes to the conclusion that the valuation that you have arrived on 10th June, taking the 31st March 24 balance sheet as the basis, it is in line with the audited balance sheet of 31st March, I am sure the income tax officer will not be able to question you much, and he will have to accept your number, because the purpose is not to see as to how accurate you are mathematically. The purpose is how fair you are in your valuation. And therefore, in my view, the last balance sheet is good enough for the purpose of the valuation. And please remember, what can be the major changes that can happen during this intervening period. Suppose if you have increased the share capital, right? So obviously you would have done the valuation for increasing the share capital, and that time you would have been fair in deciding the price, so that will automatically even out. Or secondly, what can happen, that you would have increased your assets, and for increasing your assets you have taken a debt. So if you have taken a debt, what is going to happen? On the one hand, your assets are increasing, on the other hand, your liability is increasing, and therefore it will not have any significant impact on the valuation. And that is what you must remember. What should be the date of the balance sheet for the purpose of fair market value determination? I think I have answered this question already. Is an audited balance sheet required for an unaudited balance sheet? Will also do. As I said, unaudited balance sheet will also do and should do, so long as in your valuation you are being fair and not trying to manipulate the number. How to treat the brand value of the business not reflecting in the balance sheet? So that is a question. Will you need to take into account the brand value of the company? It may be unlisted company, but unlisted company can also have a brand value. So will the brand value of this unlisted company be also taken into account in the formula of A plus B plus C plus D minus L? And the answer will depend as to what brand value are you talking about. Are you talking about a brand value which is bought by the company? That means there is an intangible asset on the balance sheet of the company for which the company has paid. Such brand value will have to be taken into account in the computation. In case you are talking about the brand value which is not reflecting on the balance sheet of the company, such brand value will simply need to be ignored because it is not reflecting in the balance sheet. Please remember, Rule 11U 1CB is only based on the balance sheet. So what is given in the balance sheet, subject to some adjustments which are again prescribed in the formula, anything other than that is simply to be ignored. Right. Now, what is the meaning of B in this formula? The meaning of B in this formula is jewelry and artistic work, right? So you will not be allowed to take, in case if the company that you're trying to value also has jewelry and artistic work, you will not be allowed to take the value which is given in the balance sheet of the jewelry and the artistic work. These will need to be valued separately by a registered valuer to find out as to what value this jewelry would fetch if it was to be sold in the open market. Now, point number, then what does the C stands for? C stands for the fair market value of unquoted shares, right? Unquoted shares. So it is possible कि जिस कंपनी का वैल्यूएशन करना चाह रहे हैं उस कंपनी के पास में अनकोटेड शेयर्स हैं, तो उनका क्या वैल्यू लेंगे? तो उनका वैल्यू यू विल हैव टू टेक by the same method as we are discussing. So a company which is not listed is holding investment in another unlisted company For arriving at the fair market value of the first unlisted company, you will also need to find out the fair market value of the second unlisted company whose shares are held by the first unlisted company, following the same method that we are discussing. What does the D stands for? D stands for the value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty in respect of immovable property. And that is what clearly given here. So in case of immovable property, you will have to refer the value which is for the purpose of stamp duty, and that is what you will need to take. Meaning what? Meaning whatever amount is shown in the balance sheet of the immovable property, you will need to simply ignore that and arrive at a new value which is based on the stamp duty, right? So there are a few more posers here. How to value unquoted shares of other companies appearing in the balance sheet of the unlisted company whose unquoted shares are being valued. I think I have already answered this question. The entity has jewelry and artistic work appearing in its balance sheet which was bought by the entity 5 years back, for which the invoice from a registered dealer is also available. Can the entity consider this price given in the invoice for the valuation of this jewelry and the artistic work? Again, I have answered this question previously. Invoice value can be considered only if the invoice is of a recent time. If it is a 5 years or old invoice or 1 year old invoice, in that case you will have to take the current value. That means you will need to find out as to if this jewelry or the artistic work is to be sold in the market today, how much will it fetch it? That will be taken as the value. Right. Now friends, look at the L. L stands for liabilities. Now please remember, as in case of the assets, not all the assets are to be taken in the computation for the rule 11U A1CB. Likewise, not all the liabilities are to be considered or to be deducted from the total of all the assets for the purpose of arriving at the fair market value of the unquoted shares as per the rule 11UA1CB. So what does it say? It says book value of liabilities shown in the balance sheet but not including the following. यानी कि आप जिस कंपनी का वैल्यूएशन कर रहे हैं उसकी जो बैलेंस शीट है उसकी सारी लाइबिलिटीज को आप डिडक्ट करोगे, नॉट द फॉलोइंग वंस. सो व्हाट आर द फॉलोइंग वंस दैट यू विल नॉट इंक्लूड? नंबर 1, द पेड अप कैपिटल इन रिस्पेक्ट ऑफ शेयर equity shares will not be deducted. The amount set apart for payment of dividend on preference shares and equity shares where such dividend have not been declared before the date of transfer at a general body meeting of the company. So that means what? That means the dividend, please remember, becomes a liability only when it is approved by the shareholders in their meeting, in the annual general meeting. It is only at that time it becomes a liability. Until then, it is not a liability of the company. It is only a proposal. And therefore, when you are calculating the fair market value as per rule 11UA1CB, you will not deduct the equity share amount, the paid up capital of the equity shares. You will also not deduct any amount of dividend which is declared but not yet approved by the shareholders in their meeting. What about the reserves and surplus? Reserves and surplus will also not be deducted as a liability for the purpose of rule 11UA1CB. Why? Because what is reserves and surplus? Reserves and surplus is at the same footing as the equity shares. So equity shares and the reserves and surplus are both the money of the shareholders, and therefore reserves and surplus will also not be deducted. Then number 4, any amount representing provision for taxation. Now what does it mean? It means that if the company has made a provision in excess of the amount of the tax liability the company has, then any such excess provision will also not be deducted. And I am sure you can very easily understand, the tax liability of the company is 100 crore. Company has made a provision of 150 crore on account of tax liability. That means this 50 crore is excess provision. It is not the liability of the company. A company has made a provision which is not correct, and therefore this 50 crore excess provision on account of tax liability will also not be deducted while computing your fair market value of the unquoted shares based on Rule 11 UA1 CB. Then of course, okay, so I think that takes care of these four aspects. A few more proposers. Is preference share capital a deductible liability? And the answer is yes. Please remember, unlike equity shares, preference share is not part of the equity. Preference share is outside the equity, and therefore preference share capital is a deductible liability while you are making computation of fair value of unquoted share. How to treat compulsorily convertible preference shares (CCPS) or compulsorily convertible debentures (CCDs) or convertible warrants? Now, friends, in my view, as the Rule 11 UA1CB says, it is based on the balance sheet, of that particular day, right? So, compulsorily convertible preference shares are to be converted in equity in future. So as it stands today, they are only liability of a company, and therefore there is no need to make any adjustment. The amount of compulsorily convertible preference share is to be simply deducted like any other liability. What about the compulsorily convertible debenture? So compulsorily convertible debenture are at the same footing as the CCPS. So compulsorily convertible debenture are also, as on the valuation date, they are a debt and not an equity, and therefore they will become equity in future whenever they are converted. So as on the date of the transfer, they are a debt, and therefore they should be deducted from the total of the assets like any other liability. What about the convertible debenture, convertible warrants? So please remember, convertible warrant is not a liability. Warrant is only an instrument. It doesn't have any liability. It is only an option that the holder of the warrant has to get that warrant converted in equity in future. As a matter of fact, convertible warrant will not even appear in the balance sheet of a company, and since they do not appear in the balance sheet of a company, convertible warrants will simply be ignored. How to treat optionally convertible debenture? So remember, as you would treat CCPS or as you would treat CCDs, optionally convertible debenture are also a debt on the date of the transfer or on the valuation date, and therefore they will be simply deducted from the total of the assets as any other liability. Is share premium a deductible liability? Friends, answer is very simple. Share premium is not a deductible liability. And why it is not a deductible liability? It is not a deductible liability because share premium is again part of the equity. So equity paid up share capital is part of the equity. Reserves and surplus is also part of the equity, and share premium is also part of the equity. Now these three components are part of the equity, so they will have the same treatment. And what is the treatment? The treatment is none of them will be deducted from the value of the assets. How to treat other than those set apart towards depreciation in 3 above? So depreciation, of course, remember when we present the balance sheet, the assets are always presented in the balance sheet after deducting the provision for depreciation. So the provision for the depreciation has already been deducted from the value of the assets, and therefore nothing is to be done about the amount of depreciation. How to treat asset valuation reserve? So please remember, the asset valuation reserve can be with regard to two types of the assets. Which are the two types of the assets? One is your immovable, that is land and building, and second, it can be with regard to the plant and machinery. So please remember, as far as the land and building is concerned, Rule 11 A1CB very clearly says that the value of the immovable assets, that is land and building, will be taken not what is given in the balance sheet, but will be based on the value for the purpose of stamp duty. And therefore, as regards the land and building, if there is any asset revaluation reserve, that asset revaluation reserve will simply need to be ignored. And why it will need to be ignored? Because the rule has very clearly said that the value of the land and building will be based on stamp duty basis. As regards the proper plant and machinery, please remember the rule does not talk about anything on as far as the plant and machinery is concerned. So therefore, if in the past plant and machinery has been revalued by the company, then such revaluation will need to be simply ignored. So if there is a revaluation of the assets, the to the extent there is a revaluation, that will need to be knocked off, and corresponding the amount of the revaluation reserve that would appear on the liability side, that also will need to be knocked off for the purpose of Rule 11 UA1 CB. Right. So then there is clause 5, provision made for meeting liabilities other than ascertained liabilities. इसका मतलब क्या है? इसका मतलब ये है कि only those liabilities will be allowed to be deducted which are ascertained. Unascertained provision for the unascertained liability will not be deducted. So कंपनी को बैड डेट का प्रोविजन करने की जरूरत नहीं है, लेकिन कंपनी ने 50 करोड़ का प्रोविजन फॉर बैड डेट किया है, विच इज अपीयरिंग ऑन द लायबिलिटी साइड ऑफ द बैलेंस शीट. सो दैट प्रोविजन विल हैव टू बी knocked off. It will not be deducted. Why it will not be deducted? Because this is not a real liability of the company. It is only fictional or notional liability which the company's management has unnecessarily provided, even though it is not necessary. Any amount representing contingent liability other than the arrear of dividends payable in respect of cumulative shares. So please remember, contingent liabilities, as I said earlier, do not appear in the balance sheet in any case. Contingent liability is below the line item of the balance sheet, and therefore any amount of contingent liabilities will also not need to be deducted. Arrears of dividend payable in respect of cumulative preference share, yes, of course, because any arrear of dividend in respect of cumulative preference shares is a liability of the company, and that will need to be deducted for sure. What is the meaning of PB? I think we have discussed it already, which is the number of equity shares that are to be valued. What is the meaning of PE? PE का मतलब है the total number of shares of that company. So this is, friends, your clause by clause discussion on Rule 11 UA1CB. Now there are few more posers that I can take, but before I take these posers, let me throw it open to every one of you. In case if you have any question, any doubt, you can please unmute yourself, ask your question. I will take your question, and then we will take these posers.